So let me ask you something. Have you ever had $2,000 sitting in your checking account and you know you should invest it, but then you start thinking, well, what if the market crashes next week? What if I buy at the top? Maybe I should wait until things look a little better. And then 3 months go by and that money is still sitting there and the market's up 12% and you're kicking yourself. Yeah, that was me for like 2 years straight. And it cost me tens of thousands of dollars in gains that I will never get back. My name is John, and I spend way too much time thinking about why smart people make terrible investing decisions. If you're someone who knows you should be investing consistently, but finds yourself constantly second-guessing when to buy, or you've got money just sitting in a savings account because you're waiting for the right time to invest it, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we're talking about dollar cost averaging on Autopilot, and here's the thing. This isn't just about setting up automatic transfers. This is about understanding why your brain is literally sabotaging your wealth and how to completely remove yourself from the equation so you can actually build the portfolio you want without the psychological torture. Look, I need to start by saying something that's going to sound controversial. You are terrible at timing the market. I'm terrible at timing the market. Warren Buffett is terrible at timing the market. The difference is, Warren Buffett knows he's terrible at it, so he doesn't try. Here's what most people don't realize. According to a study from Dalbar, they analyze investor behavior every year. The average investor underperformed the S&P 500 by about 3.5% annually over the last 20 years. Not because they picked bad stocks, not because they invested in terrible funds, but because they bought high when they felt confident and sold low when they got scared. Think about that. The market returned around 10% annually during that period. The average investor got maybe 6.5%. That difference doesn't sound huge until you do the math. On $100,000 over 20 years, that's the difference between $386,000 and $672,000. You just lost almost $300,000 by trying to be smart about timing. Now you might be thinking, okay, John, but I'm not trying to time the market. I'm just waiting for a good entry point. That's timing the market. That's literally the definition of timing the market. Here's the psychological trap we all fall into. When the market is up, we think, it's too high, I'll wait for a dip. When the market dips, we think, what if it dips more? What if this is the start of a crash? And when the market crashes, we're too terrified to invest because what if it crashes further? We've literally created a mental framework where there is never a good time to invest. Never. And meanwhile, people who just automatically invest every single month without thinking about it are building generational wealth while we're over here playing four-dimensional chess with ourselves. Let me show you how powerful this actually is with real numbers, because the math here is honestly kind of shocking. Let's say you've got $6,000 right now that you want to invest. You've got two choices. Option 1, you invest all $6,000 today, lump sum, done. Option 2, you invest $500 per month for the next 12 months. Classic dollar cost averaging. Now, if we look at historical data, and I'm pulling this from Vanguard's research on dollar cost averaging versus lump sum investing wins about 2/3 of the time. The market trends upward over time, so statistically, investing everything today gives you more time in the market, which usually means better returns. But here's where it gets really interesting. That other 1/3 of the time, dollar cost averaging doesn't just win, it saves you from catastrophic psychological damage. Let's say you invested that $6,000 in January 2008. By November, you would have been down about 37%. Your $6,000 would be worth $3,780. You would have lost $2,200 in 10 months. Now, if you had dollar cost averaged $500 per month instead, you would have bought stocks when they were expensive in January, sure. But you also would have bought stocks in March when they dropped, and in September when they crashed, and in November when everyone was panicking. By the end of the year, you would have invested the same $6,000, but your average cost per share would be significantly lower. But here's what most people don't realize about this scenario. It's not actually about the returns. It's about whether you stay invested or not. Because here's what really happened in 2008. According to data from the investment company Institute, investors pulled out $58 billion from stock mutual funds during the worst of the crash. $58 billion. These people locked in their losses because they couldn't handle watching their portfolio drop. The person who lump sum invested and then watched their $6,000 turn into $3,700 there's a pretty good chance they panic sold. They were down 37% on a single decision they made, and every day they looked at their portfolio, they regretted that decision. The person who was dollar cost averaging, they were also down, but psychologically it felt completely different. They didn't make one big decision that they regretted. They were making small, consistent decisions. And when the market dropped, they got to buy more shares with their monthly contribution. It actually felt good to see the market drop because they knew they were getting a discount. This is the psychological shift that changes everything. Dollar cost averaging doesn't just reduce your risk, it reduces your emotional attachment to any single investment decision. So now let's talk about putting this on autopilot, because this is where people mess it up. Look, manual dollar cost averaging doesn't work. I need you to understand this. If you have to manually log into your brokerage account every month and click buy, you will skip months. You just will. In March 2020, when COVID hit and the market dropped 34% in like 3 weeks, how many people do you think manually invested that month? According to Charles Schwab's data, new account openings actually surged, but trading activity among existing investors dropped. People froze. The ones who had automatic investments set up, they just kept buying. They didn't have to make a decision. The decision was made. Here's the thing about willpower. It's a finite resource. Every single time you have to decide whether to invest or not, you're burning willpower. And on the months when the market looks scary, your brain will find a reason to wait. Just this 1 month. Just until things stabilize. But on autopilot, your emotions don't get a vote. The transaction happens whether you're feeling confident or terrified, whether you're paying attention or not, whether the market is up or down. Let me give you a concrete example of what this looks like in practice. Let's say you're 28 years old, and you decide to invest $400 per month into an S&P 500 index fund. That's $4,800 per year. You set it up to automatically withdraw from your checking account on the first of every month and automatically purchase shares. If we assume historical average returns of about 10% annually, and yes, I know past performance doesn't guarantee future results, but we need some baseline. Here's what happens. After 10 years, you've contributed $48,000. Your account is worth about $81,000. After 20 years, you've contributed $96,000. Your account is worth about $300,000. After 30 years, you've contributed $144,000. Your account is worth about $904,000. After 37 years, when you're 65, you've contributed $178,000 of your own money. Your account is worth about $1.6 million. $1.6 million from $400 per month that you never had to think about. Now let's say you tried to do this manually and you skipped investing during the scary years. Let's say you skipped 2008, 2020, and one other recession year. Just 3 years out of 37, your final account balance drops to about $1.2 million. You just cost yourself $400,000 by skipping 3 years. Now you might be thinking, but John, what if I invest automatically and then the market crashes right after I start? Wouldn't it be smarter to wait? Okay, let's test that theory with the worst-case scenario. Let's say you started your automatic $400 monthly investment in October 2007, literally right before the worst financial crisis since the Great Depression. For the next year and a half, you just watched your portfolio bleed value while you kept investing. It would have felt terrible. But here's what actually happened to that money. According to Morningstar's analysis, if you started investing $500 per month in October 2007 and continued through the entire financial crisis without stopping, by 2015, you would have been up about 47%. By 2020, you would have more than tripled your money. The people who waited for the right time after the crash, most of them didn't get back in until 2010 or 2011, after the market had already recovered significantly. They missed the entire rebound. This is where it gets really interesting, because there's actually research on this. Fidelity did a study where they looked at their best performing accounts from 2003 to 2013. You want to know what they found? The best performing accounts belonged to people who were dead. I'm not joking. The second best performers were people who forgot they had accounts. The worst performers? Active traders who were constantly trying to optimize their timing. Dead people beat active investors because dead people can't panic sell. They can't wait for a better entry point. They can't get clever. They just stay invested. Autopilot investing is basically the same thing, except you don't have to die first. Here's what most people don't realize about wealth building. It's not about being smart. It's about being consistent and not doing stupid things. Look, I spent years trying to optimize my investment strategy. I read books. I followed market news. I tried to buy dips. And you know what? I would have been way better off if I had just set up automatic investments on day one and then forgotten about it for a decade. Because here's the secret that the financial industry doesn't want you to know. Complexity is not your friend. The more decisions you have to make, the more opportunities you have to mess up. When you put dollar cost averaging on autopilot, you're removing hundreds of decisions from your life. You're not deciding whether to invest this month. You're not deciding how much to invest. You're not deciding when to buy. You're not checking the market news to see if now is a good time. You just wake up on the first of the month and shares are in your account. That's it. I need to be really honest with you about something. Your brain is going to fight this strategy so hard. Let me tell you a story that illustrates this perfectly. I have a friend, we'll call him Marcus, who started working as a teacher when he was 25. Teachers don't make a lot of money, right? Marcus was making about $42,000 per year. But on his very first paycheck, he set up automatic contributions to his 403(b) retirement account, 10% of his gross pay. He never saw that money. It just went straight into his retirement account and got invested in a target date index fund. For the next 30 years, Marcus lived on 90% of his income. He got raises over time, ended up making about $68,000 by the end of his career, but he always maintained that 10% automatic contribution. He never increased it, never decreased it, never touched it. When Marcus retired at 55, his 403(b) was worth about $950,000. He had contributed maybe $180,000 of his own money over his career. The rest was compound growth. Meanwhile, I knew people making twice what Marcus made, lawyers, doctors, corporate executives, who were nowhere near retirement ready because they kept waiting to start seriously investing. They were going to do it next year. They were going to do it when they got their next bonus. They were going to do it when the market looked better. Marcus didn't make more money than these people. He didn't work harder. He didn't pick better investments. He just automated the process on day one and then forgot about it. That's the power of putting this on autopilot. All right, let's get into the actual steps to set this up, because if you don't walk away from this video with a clear action plan, this is all just entertainment. Step 1. Open the right account. If your employer offers a 401k with a match, that's where you start. That match is free money. It's an immediate 100% return on your investment. If you don't have a 401k or you've maxed out the match, open a Roth IRA with a low-cost brokerage like Vanguard, Fidelity, or Schwab. Step 2. Choose your investment. Here's where people overthink it. For most people, the answer is embarrassingly simple: a total market index fund or an S&P 500 index fund. That's it. Vanguard's total stock market fund has an expense ratio of 0.03%. You're getting instant diversification across thousands of companies for basically free. If you want even less decision-making, choose a target date fund. These automatically adjust your asset allocation as you get closer to retirement. You literally never have to think about rebalancing. Step 3, and this is the crucial part, set up automatic contributions. Most brokerages let you link your checking account and set up automatic transfers. Pick a number you can consistently afford every month. I don't care if it's $50 or $500. The amount matters less than the consistency. And here's a pro tip: set the automatic transfer to happen the day after you get paid. If you get paid on the 15th, set your automatic investment for the 16th. The money leaves before you get used to having it. Step 4. Increase it annually. Most people get raises at work, right? When you get a raise, increase your automatic investment by half of the raise amount. If you get a 3% raise, increase your investment contribution by 1.5%. You still get to enjoy some of the raise, but you're also accelerating your wealth building. Step 5, and I cannot stress this enough: do not look at your account during market crashes. Seriously, the only reason to log into your brokerage account during a bear market is if you're increasing your contributions. Otherwise, stay away. You're just going to scare yourself and make emotional decisions. Here's something I wish someone had told me when I started investing. Market crashes are gifts for people with automatic investment plans. Think about it. Think your dollar cost averaging on autopilot, a market crash means your monthly contribution buys more shares. In 2020, when the market dropped 34% in 3 weeks, my automatic investments were buying shares at a massive discount. I didn't have to time the bottom. I didn't have to be brave. The system just kept buying. By the time the market recovered later that year, those shares I bought during the crash had gained tremendous value. But I didn't do anything special. I didn't make any smart decisions. I just didn't cancel my automatic investments. This is what Nassim Taleb calls anti-fragile, a system that actually benefits from volatility and chaos. Manual investing is fragile because it depends on you making the right decisions at the worst possible times. Automatic investing is anti-fragile because it takes advantage of volatility without requiring any decision-making from you. Keeping too much money in safe accounts isn't actually safe. You're guaranteeing that you'll lose purchasing power over time. Here's the thing about all of this. Dollar cost averaging on autopilot isn't actually an investing strategy. It's a life strategy. It's about recognizing that you have limited mental energy and you should spend that energy on things that actually matter. Your career, your relationships, your health, your hobbies. Not on staring at stock charts trying to time the market. It's about understanding that discipline isn't about making the right choice every single day. It's about making the right choice once and then building systems that enforce that choice automatically. It's about accepting that you're not going to beat the market, and that's completely okay, because you don't need to beat the market to build wealth. You just need to participate in the market consistently over a long period of time. The people who get rich from investing aren't the ones with the best stock picks. They're the ones who start early, invest consistently, and don't do anything stupid for several decades. That's it. That's the whole secret. So here's what I want you to do right now. Not tomorrow, not next week, right now. If you already have a retirement account, log in and check if you have automatic contributions set up. If you don't, set them up today. Even if it's just $50 a month. You can always increase it later, but get the automation in place. If you don't have a retirement account, go to Vanguard, Fidelity, or Schwab's website and start the application for a Roth IRA. It takes maybe 20 minutes. Do it while you're thinking about it. And if you're already doing this, if you already have automatic investments running, leave a comment and let people know how long you've been doing it and how it's changed your financial life. Because I guarantee there are people reading the comments who need to hear your story. Look, I can't promise you that the market will go up next month or next year. I can't promise that. There won't be crashes or recessions. But I can promise you this. If you set up automatic dollar cost averaging today and stick with it for the next 20 or 30 years, you will be wealthier than 90% of people who try to be clever with their investments. You will beat the active traders, the market timers, the people who subscribe to expensive investing newsletters, and the people who are waiting for the perfect time to start. Not because you're smarter than them, but because you removed yourself from the equation and let the system do its job. That's the power of putting this on autopilot. If this video helped you, hit that like button and subscribe, because I make videos about this stuff every week. And if you want to go deeper on building wealth without losing your mind, check out the video I made about why budgeting is making you poor. It's going to completely change how you think about managing money. Thanks for watching, and I'll see you in the next one.